channel. I'm Professor Don Bush, and I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting, so welcome aboard. Today we are going to study adjusting entries. Adjusting entries are usually learned in probably about your third, fourth week of accounting class. So we're using Fred's Snowblower Service, and it's a real business. Change the names to protect the innocent. And here we go. I'll tell you what we're going to do. So here's what's going to happen, folks. We are going to take this unadjusted trial balance. So what has happened here? Fred has done his accounting for the month of October, and he has done a brilliant job, perfect job, no mistakes. In fact, if you look here, his trial balance balances out, and it's all looking good, not a single mistake. So what we're doing here over here to the right is producing an income statement based on this unadjusted trial balance. Now, why in the world would we want to do this? Well, we really don't want to do this, but it's just for illustration purposes. You never would do this. And what it is, it's a income statement based on the unadjusted trial balance, just so we can see what happens to the net income. Now, what we're going to do is we're going to do some adjusting entries, and we'll make an adjusted trial balance and do another income statement, and you'll be able to see if how things are different, and there will be a difference here. So what I'm getting at is adjusting entries are important. So here we go. Fred Snowblower Service, unadjusted trial balance. Fred did a good job, no mistakes. So coming down here, we will have some adjusting transactions here. So here, and I really spelled it out so that way hopefully it's clear, and I'll explain it as we go. And then what we'll do is we'll take these adjusting transactions here, or adjusting entries, I'm sorry, and we will make adjusting journal entries right here. And now these adjusting journal entries will get posted into the general ledger, as they always do. But what we're going to do is we're going to use a little tool here, and it might look really scary, but it isn't. It is so easy, guys. I love this. It's a worksheet. It's not an official part of the accounting records at all, and we're just going to use it to go from the unadjusted trial balance to the adjusted trial balance. And this is a fabulous way to do it because it lays it all out. You can see it, it makes sense, and you know if you've made any mistakes. And then what we'll do is we'll take this adjusted trial balance and we will create a second income statement, and you'll be able to see there are some differences, and this adjusted income statement is much more accurate, much more precise than the unadjusted one. So it's a process that accountants do. And by the way, if you are studying to be an accountant, this is an area that you will be doing quite a bit because it's something that's a little difficult. It's hard for some people to think these adjusting entries through, and they need to be done correctly. And it usually takes a little bit of knowledge and skill and education to do it, but you can do it. It's easy. So here you go. So let's see what we've got going on with this unadjusted trial balance. As mentioned, Fred did a perfect, beautiful job. Everything lines up. The trial balance balances out just as it should. And it looks like Fred here has made some revenue, had a good year, or good month, I'm sorry. And cost of goods sold is $5,000. Now, cost of goods sold, you may or may not have studied this, but cost of goods sold is an expense. Now, we just call it cost of goods sold, and everybody knows who does accounting that it's an expense, all right? It doesn't say expense, but it's an expense. It's one of those rare times where you just have to know. All right, and then we've got rent expense, marketing expense, and wages expense. Now, folks, we've also got something that might be new to us here. Unearned revenue. Unearned revenue. It is not revenue, it's unearned revenue. So this happens when a customer or a client will pay Fred in advance. I don't know why anybody would want to do that, but some people will pay in advance for whatever reason. And a lot of times it depends on the profession too. I know attorneys like to get paid in advance. A lot of folks do. People that do consulting work at least get half paid in advance. So there are times where you do want to get paid in advance. Now, some customer paid Fred $500 in advance. Now, Fred has not done the work yet, but Fred will. Fred will get the work done, but right now that work is unearned. The work hasn't happened. Dividends, that's money coming out of the business for personal reasons, for the owner. The owner's taking money out. Maybe the owner, Fred here, wants to go to Disneyland, so he pulls out some money out of the business account and goes to Disneyland. Well, that's for a personal reason. Let's see here, retained earnings. Retained earnings is a little bit tricky here for a lot of folks. It's $11,500. What does it mean? Well, it's simply the profits that have been retained in the business. And retained earnings is calculated on the statement of changes of retained earnings. And we've covered that a time or two. Very easy statement. Let's see here. So let's go over here to the income statement. This is the unadjusted income statement. There's no reason why you would want to do this. I'm just doing it here for illustrative purposes. But I just made an income statement. What goes on the income statement? Well, revenue and expenses. Nothing else goes on the income statement. Well, I got to be honest, there are a few other things that go on the income statement, but for right now, revenues and expenses. If you're starting out in accounting, never, ever, ever put anything else on the income statement. All right, revenues and expenses. Revenue, that's money coming in from doing your job. Expenses, that's money going out from doing your job. All right, so here we go. So let's go down here to these adjusting entries. So number one here, Fred did more work than is reflected in the unadjusted trial balance. Fred completed $2,000 of work at the end of October, but did not have time to send a bill to the customer, which is an accounts receivable. When customers owe you money because you did your job, that's an account receivable. It's very, very important to keep good track of accounts receivable, because if you don't, your customer will not. All right, so you got to keep track of it. It's on you. Since Fred did not send a bill to the customer, the completed work has not yet been recorded in the accounting records. Regardless, the revenue was earned in October and should be included in October. So when Fred gets to it, he'll fill out a bill and send it off to the customer. But for now, let's record this revenue as being completed. So what we're going to do is we're going to debit accounts receivable. Accounts receivable is an asset. Assets are always debits. They have debit balances. Revenue is a credit. Revenue is a credit for $2,000. And a good way to remember this is revenues are always credits. They always go on the right-hand side. So there you go. So this will update the amount of earnings that Fred has, the amount of revenue. And it's good to really know how well you did during the month. Number two, according to the unadjusted trial balance, Fred should have $1,500 worth of parts inventory. However, Fred took inventory of his parts and estimates that the amount of parts sitting on the shelf is really $600. Fred is confident none of the parts have been misplaced or stolen, but rather used to complete repair work. So according to the unadjusted trial balance right up here, here we go, going back up there. Here's the unadjusted trial balance. According to the parts inventory, Fred should have $1,500 of parts inventory. But he doesn't. He went and looked at his parts inventory, and he doesn't have $600, or he doesn't have $1,500. He only has $600 of parts inventory. That's all he has. So again, it's kind of like this. If you start out with 5 apples and you have 3 apples left, how many apples did you eat? It's kind of like that. All right. So in other words, can you figure out from the information in number 2, what's the value of the parts that Fred used up? Well, I hope you came up with $900, all right? So when you use up resources, when you use up assets, that's called an expense. And Fred is doing this because of his job, right? So these are resources being used up because Fred is doing his job. So he has parts expense of $900 because $900 was used up. And we can figure that out from the $1,500 that his account says and the $600 that he really has left. And we'll reduce the parts inventory by $900. So this credit to parts inventory, this putting it on the right hand side will reduce parts inventory by $900. And if you think about it, this makes sense. And now on to entry number 3. Fred has never depreciated his equipment because Fred was not sure what depreciation was. Well, Fred's in the majority because most people really don't understand what depreciation is. The way we talk about depreciation is different than how accountants talk about depreciation. And what I'll do is I'll make up a separate video on this, because if I spent the whole time on this, this would be a long video. So I'll make a separate video talking about depreciation. So some of this you're going to have to just take on faith, okay? So however, Fred has determined that he should depreciate his equipment by $200 for the month of October. Now, depreciation is an expense, all right? And expenses are on the left-hand side. They're always on the left-hand side. Look at that. Parts expense, left-hand side. Depreciation expense, left-hand side. Do you see a pattern happening here? Now, the offsetting credit is accumulated depreciation. And right at this point, you're probably wondering, what the heck is accumulated depreciation? And I won't get into it right now. But for now, know this is the correct entry. It truly is. And I'll make up a different video for it. So this records the depreciation. By the way, this depreciation expense is a beautiful, wonderful thing if you're a real estate investor, because depreciation is tax deductible, but there's no cash involved. Take a look here. Entry number 3, do you see any cash involved here? Not a bit, right? So depreciation is a big expense and you're not spending any money. Pretty sweet. So number 4 here, transaction number 4, a customer paid Fred $500 in advance to repair a large snowblower. That's the $500 I was telling you about. Fred knows to never claim revenue unless Fred has completed his work, and that is so key with revenue. You never ever record revenue unless you have done your job. And this is really important. It's the number 1 form of accounting fraud and financial fraud, and people go to prison for this. So you want to know this. As a result, Fred has a $500 balance in the account, unearned revenue. Fred believes that he has earned $300 of the $500, okay? So he's done some of the work, not all of it, but he's done some. Fred should claim revenue and reduce unearned revenue for the $300 of work completed. So what we're going to do is we're going to put on the left-hand side, we're going to debit unearned revenue, which reduces unearned revenue by $300. And we're going to credit revenue by $300. And look here, transaction number 1. When Fred earned that money, we put revenue on the right-hand side. When Fred earned the money, we put revenue on the right-hand side. That's how it works. Just that easy. Now, coming down the list here. Number 5, as of the end of October, Fred's workers have worked hard and have earned $700, but have not been paid. Now, it's not because Fred's withholding their wages or anything. It's just that payday hasn't come yet. The $700 represents an expense for the month of October and should be included in the month of October. Rather than using the accounts payable, usually reserved for inventory suppliers, Fred is going to create a new account, wages payable, to record the wages owed, a liability to the workers at the end of October. So what I'm getting at, we're going to create a brand new account here called wages payable, and we're keeping it separate from accounts payable because accounts payable by tradition is used for inventory, when you owe your suppliers of inventory. And wages payable, of course, that's when you owe money to your workers. So Fred owes $700 to his workers. So Fred is going to debit or put on the left wages expense for $700. Now check it out again, guys. Expenses are always on the left-hand side. Look at this. Wages expense, depreciation expense, parts expense, always on the left-hand side. And that is the end of our adjusting entries. So here's what we're going to do now. We are going to come down to this wonderful worksheet. It's actually kind of fun. It's sort of a little bit like a crossword puzzle, maybe. I don't know. I'm not very good with crossword puzzles, but I am good at this. So here's what it is we're going to develop this little spreadsheet down here. It's down here at the bottom of the page here on the bottom side. Up above here, I've got those adjusting entries because we want to be able to see those. And all I'm doing is writing down my accounts. Now, what I did is I highlighted here accounts that are brand new. We didn't have accumulated depreciation before. We didn't have wages payable before. What else here? Oh, we didn't have parts expense before. And we didn't have depreciation expense before. And you might say, what do you mean before? Well, what I mean is up here on the original unadjusted trial balance. If you look at this original unadjusted trial balance, none of those accounts are on there. And so they're brand new. Now, you might say, well, how did you know to put them in these certain places? And I did put them in appropriate places, but it's okay if you don't know where they belong. Just put them down at the bottom. Just add them all at the bottom if you have to. That's the important thing. It doesn't matter where they go, just so they're on this little sheet, okay? So we had to add a few accounts. That happens from time to time. So all you do, folks, is you take numbers off of this unadjusted trial balance, this original trial balance. Just take the numbers off there. Don't change them. Don't think too hard. And all you do is say, okay, cash, $5,000. Cash, $5,000. Accounts receivable. Accounts receivable. Parts inventory. Parts inventory. You just copy. And it gets kind of boring, so you gotta be careful not to zone out and write down the wrong numbers. And by the way, all of these numbers so far are on the left-hand side, the debit side, so write them on the left-hand side. There you go. And just continue down this trial balance. Look at this, accounts payable, $13,000. There you go. We have some blank spaces here because we've never had accumulated depreciation before. We've never had wages payable before, so that's okay too. And here's unearned revenue for $500. We'll just take it from the trial balance up here. 15,000, write down 15,000. 11,500, write down 11,500. That's all you do. Just copy it down, all the way down. And folks, then you want to add it up. And this is an important step. Don't get lazy. Add it up. Double check your work. And this 60,000 should match the trial balance. There you go. So it should perfectly match, even though we got some little spaces here and there. All right. Now, coming to the adjustments. This is super easy also. This requires like no brain power. All right. Absolutely no brain power. In fact, if you kind of turn your brain off, you might do a little better. So here you go. So on the first entry, here's accounts receivable for $2,000. Just write down accounts receivable for $2,000. And you know what? While you're doing it, you may want to check it off somehow. I think what I'll do is I'll just put it in yellow there. And in yellow, that means I did it. I know I did it. And then we have revenue on the right-hand side for $2,000. So let's go find revenue. There it is, revenue on the right-hand side. There it is. Got it. So I did that one too. Done. So let's go down to the next entry. Parts expense is on the left-hand side. So let's go down to parts expense. Let's find, there you are, parts expense. There it is. Mark it off. Done. Parts inventory is on the right-hand side for $900. Here's parts inventory, right-hand side, got it done. And so you got to go through these one by one, folks. You cannot skip any. Depreciation expense for $200. Let's go find depreciation expense for $200. There it is. Just write it down in that space. There you go. Got her done. There we go. Accumulated depreciation on the right-hand side for $200. There it is. I got it done. I did it. What I mean by got it done, I wrote it down in these two columns here. They're not going to go there by themselves magically. Okay, so you got to put them in there. Number 4, unearned revenue on the left for $300. Unearned revenue on the left for $300. There it is. I did it. Got the job done. Revenue credited for $300 on the right-hand side for $300. Let's see. There it is. Okay, now here's something that what I did, and I did this just to keep life more simple for us. Is since I was doing this on Excel, I gave myself an extra space here for revenue. And what I did is for one of the adjusting entries, I think that was for the very first one, I put 2,000, and I needed to have 300 for revenue again here. You know, this 300 right there. And so just to make things easier, I just gave myself 2 spaces. All right. And what I did is I put a little black box around it. So hopefully it would stand out a little bit more. All right. Now I could have just on one line said $2,300, but I thought I'd split it out just so it'd be easier to follow. All right. Wages expense, $700. Here we go. $700 for wages expense. There it is. It's on the left. Got her done. Okay. And then wages payable for 700. That's on the right-hand side. Wages payable. There it is. Got her done. So yeah, so what you got to do is fill in these numbers, all right? These are called the adjustments. And you don't have to think about it. You've already done your thinking. Just write them down and make sure you did every one. Now, I marked them all yellow to make sure that I knew I did them, because it's easy to lose your place, you know, if the phone rings or your friend asks you a question. Now, at the bottom of these columns, you got to add them up. Add them up here, and they equal 4,100, 4,100. So we know the left-hand side equals the right-hand side. You must add them up. Because if you don't, you might make a silly, stupid mistake, and you'll be off, and it'll be a big mess. Add them up. There you go. So we're on to the last column here, folks. The very last column. It's called the adjusted trial balance, and it is super easy. Super easy. Here's what you do. You take them one line at a time. I mean, this is really easy. Cash. It is a debit for $5,000. Nothing's happening in here, so you put $5,000. Accounts receivable is a debit for $3,000. And if you come along here, oh, we have another debit for $2,000. Well, if you add these two debits together, you get a debit for $5,000. Easy. Parts inventory. Now, the parts inventory, don't get tricked on this. Don't get fooled. It has a debit balance of $1,500. And here's a credit. So I've got a lefty and a righty. So lefty is bigger than the righty. So I'm going to put a debit of $600. Well, because $1,500 minus $900 is $600, and the debits are bigger. All right. Merchandise inventory is $20,000. Nothing's happening, so we write down $20,000. Equipment is $15,000. Nothing's happening. $15,000. Now accumulated depreciation, we have nothing in the unadjusted trial balance, but then we have a credit for $200. So simply put it in the credit side, $200. Accounts payable, $13,000 on the credit side. Nothing's happening. There you go, credit side. Wages payable, nothing. We have a credit here for $700. Put $700. Unearned revenue. Now we have a credit here for $500, and then we're debiting it for $300. Now, debits and credits are kind of like cats and dogs. They don't get along real well. You got to subtract one from another. So we have a credit for $500. A debit for $300. So we're going to subtract, and the balance is going to be a credit for $200. Now, why is the balance a credit for $200? That's because the credits are bigger. The credits won, they're bigger. Common stock. We have a credit for $15,000. Nothing's happening, so we have a credit for $15,000. Coming down the list here. Retained earnings. A credit for $11,500. Nothing's happening, so $11,500. Dividends, we have a debit for $1,000. Nothing's happening, and we have a debit for $1,000. Revenue. Now, this is where I gave myself some extra space here. We have a credit for $20,000, a credit for $2,000, and a credit for $300. Well, they're all credits, so add them all up. They all add up to $22,300. Cost of goods sold. Cost of goods sold is an expense. It doesn't say expense, but it's an expense. A debit for $5,000, nothing happening, so $5,000. Rent expense on the left for $1,000, nothing happening. There you go. And all marketing expense, same thing. Now wages expense, look at this, a debit for $6,000, a debit for $700. It all adds up to $6,700. Parts expense, nothing happening here, but we have $900 as a debit, $900. Depreciation expense, nothing happening. We have a debit for $200. Boom, there you go. So here we go. So what we're going to do, folks, is here, I'll show you what we have. Let's go back up here to the top. We've got the unadjusted trial balance, and you know where that came from. That came from that original trial balance. We did all our adjustments that came from these adjustments here. And now we have our adjusted trial balance. And what we're going to do is we're going to do one more income statement. And this income statement will be much more accurate, much more reliable, and it'll really reflect what's going on. Now, what goes on in an income statement? There's only two things. I hope by now you know what those two things are. And if you don't, shame on you. You should know this. The two things that go on the income statement are revenues and expenses. That's it. Nothing else. At this point in your accounting education, that is it. Revenue and expenses, nothing else. Now we've got revenue here, $22,300, and we've got a bunch of expenses. So let's make us an income statement. So here we go. We've got Fred Snowblower Service, and I listed it here as adjusted income statement. That's usually not what people do. Usually people just say income statement. But here you go. Here's the revenue, folks. And I'll come down here, so come down the page here, down the split. So that way you can see these expenses, all right? So there we are. So all you do, guys, cost of goods sold, $5,000, $5,000. Rent expense, $1,000. Marketing expense, $2,500. Wages expense, $6,700. Parts expense, $900. And let's see if we have any more. Depreciation expense for $200. There you go. So we've got a fair amount of expenses. We've got $16,300 of expenses. So Fred's net income is really $6,000. And if I go up here to the original income statement, and I can't fully display it on my screen because it's just too much. So right up here is the original income statement, right up here, unadjusted income statement. And you don't do those. I just put it there for illustrative purposes. Now the net income on the original income statement was $5,500, but after we adjusted the accounts and made things more accurate, it's $6,000. Now, after you do your adjusting entries, it doesn't always happen that your net income gets bigger. Just as often, your net income will be smaller. There's no way to really predict, but these adjusting entries are important to do, and they make your financial statements much more accurate. Now, you might say, hey, what's the big deal? You know, there's not much of a difference between $5,500 and $6,000, and you're right, there's not. But the thing is, oftentimes there is a huge difference, a monstrously huge difference. Boy, I used to do accounting for a small retailer that had two outlets. And when I did their adjusting entries, they would amount to over $1 million. And for a small business, it made a huge impact. It was just huge. But you know, one thing I'm interested in is without the adjustments up here in the original income statement, the repair revenue was $20,000. And down here, it's $22,300. So Fred's, you know, that's 10% more revenue that from the original income statement. So this one's more accurate. It's more accurate. So there you go. So ladies and gentlemen, I hope this helped you on your very first introduction to adjusting entries. Once you get used to them, they're really easy. They take a little practice, and there's something that accounting majors ought to be really interested in. If you're not an accounting major, then this is not too big of a deal. Do what you can to pass this part of the class, and don't worry about it too much, because it usually takes a good accountant to do this. So folks, if you enjoyed this, hit that like button, smash the subscribe button. Let me know that you like these.